Welcome to this Killick Explains video. Apologies for the lack of a studio, but hopefully something we can remedy after Christmas. So, to the 12 Fails of Christmas Part 1. 6 Common Investing Mistakes Worth Avoiding as we head into 2021. So the background to this would be what? Well, I've given you a flavour for it. 2020's stock market gyrations have thrown out winners and losers, depending on the approach people took. So what makes the difference between the two? Well, avoiding what's in fact a dozen common investing mistakes is pretty key. If you fell into some of these traps in 2020, try not to in 2021. So in this video, numbers 1 to 6. So first of all, single stock investing. Now because I've covered these in some cases elsewhere in more detail, I'll keep this fairly brief. Single stock investing is a bad idea, but boy has it been tempting this year with pharmaceutical companies chasing a vaccine and technology stocks lifting off and so on. But this is gambling, not investing. Piling all your money into a single stock, and it's particularly dangerous for employees of firms who pile their money into shares in the business they work for within, say, a self-invested personal pension, not realising that leaves them horribly exposed if things go wrong. Any stock can suffer a collapse. Looking back over the past, BP, Marks and Spencer's, Tesco, G4S, these are all firms that people thought were fairly solid and stable by any traditional metrics, but have all at different points in the past suffered fairly catastrophic share price falls and or dividend cuts. Beware bandwagon traders and survivor bias in this particular market. Bandwagon traders are people who jump onto an idea because momentum is carrying it upwards, and they tend to be the kind of people that will only tell you about their winners and not necessarily about losers. So watch out for those two things in the context of what's been a fairly lively stock market over 2020. Now, panicking is number 2. Tempting to do so this year. After all, if we look back, as the pandemic hit, the stock market fell, depending on which one you look at, by a third or more, pretty much across the board. But a few weeks later, very, very rapidly, it had bounced back and recovered. So this is another example, 2020 a big one, of the price people pay for panic selling. A lot of people have seen all their monitors turn red, the headlines talk about disaster, the end of the world, and actually, as we come into the end of 2020, things are looking a good deal healthier for the global economy. So panicking didn't work out well this year, and it's rarely worked out well, if at all, in the past. Number 3 is forced selling. Now, this one is one you need to watch out for. It's a planning problem, essentially. No one wants to sell just as the market heads into one of its inevitably larger dips, and drawdowns of 10, 15, 20% or more are relatively common in stock market history. The good news is the market's always gone on to recover and go on to better and greater things. But you don't want to be selling into a dip, and that can happen where, for example, you get your timing wrong. So suddenly you've got to liquidate shares at a point where it's not really the best point in the cycle to do so. So this is where planning and the 3 pots approach comes in. It's about being organised. Set aside that rainy day fund, which will see you through bad times without you having to touch your share investments. Look out for those foreseeable calls on capital. That's big drawdowns that you know are coming, whether it be school fees paid up front, for example, a house purchase. You can plan for them. It's not as difficult as it sounds. Get yourself organised to meet those, and then the rest of your wealth can happily trundle along beyond things like your property. Most people want to own their own home, that's fair enough. Can trundle along in equities, riding out any dips that may hit your portfolio as you travel. Then there's crowd following. And goodness me, has 2020 been a year when people have been tempted to do this one? So basically, the safety of crowds can seem alluring. Well, that many people can't be wrong. Everyone else is doing it, and the success of apps such as Robinhood demonstrate the power of that kind of thinking, if you like. But it inevitably leads a lot of people to buy high and sell low, and that's because they're late to the party, both on the way up and on the way down. And if you think about it, buying high and selling low is the exact opposite of what most investors want to do. So stick to your strategy and avoid fads. Yes, it would have been lovely to climb on board the right vaccine producer just ahead of their announcement of a successful vaccine, but very, very few people would have got their timing right. And so stick to your strategy, avoid fads, take a reasonable return, don't be too greedy, rather than trying to shoot the lights out in any one particular period or year. Then there's rear view mirror investing, and we all do this in life as well as in the stock market. So this is the idea that the past is no guarantee of the future. We know that, regulators hammer that message home, and yet we do cling to the past. It offers a degree of safety, it offers something we know about. So don't worry about what might have been. Looking back can manifest in people saying, well, what if I'd bought such and such a stock, Amazon at its IPO, for example, or one of the big technology unicorns, what if I'd done that? And the problem is, well, you can't change history, but it can lead people to take unnecessary risk in some sort of vain attempt to catch up, not miss the next boat, if you like. Markets only ever look forward, and so should you. And that's a really important point. Look at the decisions you're going to make today. Look at how the future looks in terms of the price of a particular stock, for example. Don't look backwards. Don't look back at what might have been. Look ahead to what might be. And finally, anchoring, which is connected in a way but a slightly different point. And that is the idea that we are tempted sometimes to set arbitrary data and price points and benchmarks. And they're arbitrary because we've created them, so they kind of only exist in our heads. So the market doesn't really care what you think, is the takeaway here. So people who say, well, I'm not going to sell this share until it gets back to break even. It's taken a dip until it gets back to break even. I won't even think about selling. Well, that might be the right attitude, but what if it never gets back to its break-even price? There is an opportunity cost to leaving your money languishing somewhere where it's not earning any returns. Now that opportunity cost may be, you could argue, relatively low if you're looking at the return available on cash, for example. But if you're looking at the return available on shares in 2020, the right sorts of shares, then that opportunity cost rises substantially, as indeed it does for property. Although one has to say, once the stamp duty holiday ends in March, all bets may be off in that department. So there you have it. 6 things to avoid in 2021. Festive fails, as I've called them. 6 more coming up in part 2.